All right, the topic of today's conversation is impulse. Impulse is something that really isn't considered by a lot of people when they buy and sell stocks or as they approach the markets. So the first thing we want to do is define it, and then we can take a look at how you use it, because it has a lot of really cool things you can do with it. So as we know, we talk about this a lot, but markets move in two dominant phases, which are expansion and contraction. So impulse is basically your expansion phase. All right, so that's this period of qualified moving price in one direction, something that we can model. Okay, so we're going to talk about that in an up market. So we're going to have prices moving higher. All right, and then we're going to have our consolidation, and then we're expecting a continuation of that. So again, this is the expansion, this is contraction, and then we have further expansion. So this initial expansion phase that precedes our contraction phase that we're analyzing, this is impulse. All right, that's called the impulse. So what most people don't take a look at this or consider when they're buying and selling a stock. So they say, well, I'm just going to buy shares of XYZ. Well, they don't have a way to model that. There's no way to structure it so that they can repeat the process over and over again. But if we can identify and correctly analyze impulse, or the impulse that precedes our contraction phase, then there's a lot of things that we can do to forecast and take low risk entries, expecting that continuation and that further expansion. And then depending on what happens is this expansion then becomes another impulse for some type of move. So impulse has to do a certain number of things in order for it to be analyzed correctly. And so one of the things that a lot of traders run into when they look at standard technical indicators or technical analysis indicators. So let's take a look at, we're going to move down at this point. So we're going to go down and we're going to look at we'll look at two moving averages crossing lower. So let's just say, I don't know, let's just say we have the 18 and the 50. Okay, so the 18 is down here, and that is crossed below, this one, that crossed below the 50. So this is the 50 and this is the 18. Okay, so as price moves lower, when that happens here, we have this is what's called impulse. All right, as we've discussed. Okay, so now this is just a common technical indicator that will elicit some type of reaction, and then the trader either is going to try to get on as early in that cycle as possible, or following some contraction. But the issue is what happens in here is extremely important, and the nature of the price action in the impulse is really important. And so what a lot of traders don't understand is that impulse could be doing one of two things. It could be setting up for a continuation of that trend, or what's not good is a reversal. And if they don't know how to read that becomes a problem. So if this impulse is setting up for a reversal, price will react in the wrong direction, moving against that indicator. All right. This is why indicators in absence of proper price analysis are essentially worthless. Okay, so what you want to make sure is you analyze the impulse properly so that your continuation is effective, and then you can get the follow through and price in the direction that you want to go. All right. Another cool thing about impulse and how you can characterize it is it enables you to establish targets. So we have an uptrend followed by we'll call this our up impulse, followed by our contraction phase. All right. And then we'll expect a resumption of that trend. So in here is where we're going to put our low risk entry, right in there, where we're going to control risk and we can play a risk game. Okay, so depending on what the nature and extent of this impulse, this could set up this area here between these two lines, okay? So this is going to be like a dollar amount or some type of percentage. All right, so once that's established, that can be used to establish a target to the upside for this low risk entry. So whatever this is, let's say that's X, then we're going to use X as that dollar amount or percentage of the impulse as our target. Okay, extremely effective. The point is if you're not analyzing impulse properly and for your low risk entries, you're really going to struggle with consistency. And proper impulse analysis is a really tricky tool that enables you to do a lot of things, not just control risk, but establish targets, play effective risk games, also get really big expectancy. So don't leave home without impulse. If you want to learn more about impulse and price action and how this works and how you can model these things, you're definitely going to want to join my free training. There's a link to that below the video, and I will see you there, and have a good day.